when you lend at high rates, the only reason that you can lend at high interest rates is if the default risk is high.
There's risk in these portfolios. There will be losses.
In some ways, there were going to be problems, or the sort of problems were going to come home to roost in private equity one way or the other.
Generally speaking, the rule of thumb for a bank analyst is when you're going in, if you're going to go into a downturn or credit turn, you think about where has the loan growth been. Odds are that's where the problems are. That's what happened in 2008.
So you could be looking at very significant losses across these portfolios in any type of credit stress environment.
Is private equity about to face its biggest crisis since 2008? The jury might be out, but some investors are concerned trillions of dollars in private credit and software investments could be at risk, and AI might be the unexpected trigger. So what is really happening? In this recent CNBC interview, Dan Rasmussen from Verdad Capital explains that private credit, which is now a $1.5 trillion industry, has been lending heavily to private equity deals, especially software companies.
What do we know today about how many losses there are so far throughout the private equity and private credit spaces?
Right now, the losses are limited, Kelly. It's everyone anticipating that the losses are going to be much worse. And the reason that people are really pricing that in right now is that the big pitch, right? You got to remember that private credit is fundamentally lending to leverage buyouts. They're lending to private equity deals. And in the past few years, probably about 40% of private equity went into software or software-related businesses.
The problem is a lot of these companies don't have physical assets. The loans are backed by their recurring revenue. But now software stocks are falling. AI could disrupt their business models, and interest rates are still high. That combination now has investors concerned, to the point where they are now reassessing their exposure to the space.
So what's happening now is that as software stocks have fallen, people are saying, well, gee, I don't know if that revenue is going to be recurring anymore. And you always told me, gee, we're lending to this private credit. It's a risky business, but, there's a huge amount of private equity money in front of us. So the equity valuation is what supports the credit. Well, with software equities collapsing, people are saying, well, gee, I don't trust that equity story.
For context, private credit grew after 2008 when banks pulled back from risky lending. That void was filled when private funds stepped in and started financing leveraged buyouts. The problem is, leveraged buyouts only work when revenues keep growing, debt is cheap, and the economy stays strong. Now take a listen to what Brennan Hawken of BMO told Closing Bell Overtime.
Let's start at the epicenter with the alternative asset managers. Some of them have been just weighed down by a constant spiral of concern about what's in these private credit portfolios.
Right.
Is there value there, or should we just sort of assume that other shoes are going to drop?
There's risk in these portfolios. There will be losses. What I think is the reason why everybody has drawn so much attention to these portfolios is, generally speaking, the rule of thumb for a bank analyst is when you're going in, if you're going to go into a downturn or credit turn, you think about where has the loan growth been. Odds are that's where the problems are. That's what happened in 2008.
According to some experts, around 40% of private equity money went into software over the last decade. But the rapid rise of AI has investors asking a major question. What if AI replaces or compresses the margins of software businesses? What then? Because if recurring revenue isn't as recurring as investors thought, the entire credit structure underneath it weakens. So you see, this isn't just about bad loans. It's about technological disruption colliding with leverage.
So they've massively expanded, right? And predictably, when you lend at high rates, the only reason that you can lend at high interest rates is if the default risk is high. And if you're seeing this type of lending at the type of loan levels that private credit has been lending at, imply that this is like low single B type credit. And low single B type credit in a recession, about 30% of that defaults. So you could be looking at very significant losses across these portfolios in any type of credit stress environment. Well, the problem with private credit, right, they marketed illiquidity and opacity, and they said, gee, we're experts, we can trade these private market things, and they're better than the stuff you can access in public markets. Well, when things go wrong, people say, well, what do you own? And they've never heard of any of these companies they're lending to. And so it's too opaque. People are going to throw the baby out of the bathwater.
None of this mean we're going to see a 2008-style collapse tomorrow, but it does mean private markets may face slow burn stress and loss of confidence, which then feeds on itself. Added to that, the fact these funds are opaque and illiquid means problems sometimes only surface when things are already very serious. The MFS Financial UK collapse is a good example of that in action.
And for a large number of these, they're right to do, right? You know, for everyone like Ares maybe or HPS that are sort of the gold standard lenders, right? You go down and there's a million of these guys that have grown up in the last few years that really don't have great lending standards, that are basically lending to anyone who wants to do an LBO deal. And it was a race to the bottom.
Absolutely.
And so I think you're going to see hell to pay for those lenders. And by the way, the two other people that you can't forget are really problematic here. Private equity, which is the equity that's in front of this debt, right? So for you to lose money on the loans, private equity has to lose a lot more. And then second, a lot of life insurers have put huge amounts of private credit on their books, and it's not going to end well for them.
That sounded extremely downbeat. So here's more of what Brennan Hawken told CNBC Closing Bell Overtime, as it might ease your fears, but only slightly.
The good thing about these BDCs is that the maturities are short and they're staggered, right? There's almost inherently better liquidity. Now, it doesn't mean that if we're constraining credit flow into that market that we won't possibly make things worse and won't maybe see more defaults.
Sure.
But importantly, defaults themselves don't equal loss.
Yeah.
Right? These are senior loans. There's often collateral. You're going to recover something. So there'll be a lot of concern. There'll be a lot of scary headlines. It doesn't necessarily always translate to the losses, and that's what creates the performance issue. And that's the difference in between the flow versus the losses.
Relating to Jefferies and MFS Financial, here's what he said.
So Jefferies, this isn't the first. So we got this MFS issue that emerged yesterday. I had never even heard of this company. I thought we were talking about Massachusetts Financial, and it was the Boston-based asset manager. So we had to, reach out and talk and get an understanding. Unfortunately, the news flow has just sort of continued to deteriorate. And it seems as though a decent amount of this collateral has been double pledged. It sounds a lot like the First Brands issue. Now, the ironic thing is there's been a lot of concern and focus on the direct lending part of the private credit market. So far, actually, we've seen issues emerge from the asset-based finance part and that isn't always private credit. They do have a private credit version. So maybe the focus might shift to be a little more there. We saw Apollo underperform today. They're much bigger in that market. I suspect that's investors saying maybe we need to catch up and think about this more broadly.
So, again, there are clearly risks investors are worried about, but a collapse doesn't seem to be on the cards. At least, not just yet. But what do you think? Is private credit the next financial crisis waiting to happen? Or is this just the normal cycle of noise when markets are stretched? Drop your thoughts below, and be sure to like and subscribe for more stock market videos.